Aliko Dangote's business empire is massive. Some analysts believe his net worth could reach $100 billion by 2030. And here's the twist: he may reduce his stake to 60 to 65%. So, what does this mean for him, the Nigerian stock market, and Africa's tech scene? Let's dive in. Aliko Dangote is Africa's most prominent industrialist. His company, Dangote Cement plc, has a leading market share in West and Central Africa. Beyond cement, he built one of the world's largest oil refineries. He also owns fertilizer plants, sugar production, and logistics assets. This is not just a small company, it represents infrastructure, manufacturing, and essential markets. Now, where does this $100 billion valuation come from? Currently, Dangote Cement's market cap stands in the tens of billions. When optimized, his refinery can generate vast foreign exchange. Expanding into petrochemicals and fertilizers adds more value. Plus, growing his customer base across Africa multiplies opportunities. If the Dangote Group scales petroleum refining exports, captures regional markets, expands logistics and industrial parks, attracts institutional capital, then a $100 billion valuation by 2030 isn't just a dream, it's feasible. Now, let's discuss Dangote's stake reduction. He stated that he plans to hold about 60 to 65% of his business in the long term. This matters because a lower founder stake creates more free float in the market, increased liquidity, higher interest from global institutions, easier capital raising in the future. Investors prefer companies where founders release some equity. This creates better market participation and price discovery, making it a smart move for valuing his assets. For Nigerian retail investors, this could be significant. More free float plus potential institutional investment means increased trading volume and better valuations. If foreign funds observe a more liquid and stable Dangote stock, billions could flow in. Consider the impact on MSCI inclusion, international pension funds, commodity-linked institutional mandates. This influx could elevate Nigeria's stock market. Now let's connect this with Africa's tech community. Vital insights here. Dangote's success lies in addressing real economic issues. His empire capitalized on local demand and robust infrastructure. In contrast, Africa's tech companies often pursue fintech, digital services, social commerce, logistics tech. True capital concentration happens when tech resolves infrastructure gaps. Areas like energy reliability, supply chain automation, digital identity, real assets tokenization, and Africa-wide payment systems are ripe for innovation. This is where the next game changer could be: integrating tech with the real economy. Finally, Africans must think bigger. Dangote didn't start with a $100 billion vision, he focused on building missing infrastructure. Young African tech founders should ask, what infrastructure can we automate? How are we enhancing the economy? How can we capture value, not just follow trends? A $100 billion valuation isn't about hype. It's about creating foundational value, securing long-term capital, and strategically scaling. This is the mindset for young Africans today. So, do you believe Dangote can achieve $100 billion by 2030? What sectors of African tech could lead the way? Share your thoughts below. Like and share this video. Subscribe for real economic analysis shaping Africa's next generation. This is OB Expeditions, decoding wealth, strategy, and Africa's future.